Equity Mates, from our mates at Spaceship. Investing made easy.
To another episode of Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. Loving this week. We're only one episode of 4 down, but we've got Roger Montgomery for the whole week.
Yes, it is
That's
an
great.
absolute pleasure to welcome you back to the studio.
It's good to be with you again.
And yesterday we touched on Roger's views on crypto and also what's happening with inflation, and it was an amazing explanation. So thank you very much.
Pleasure.
So let's start with continuing that conversation around, was crypto a bit of a bubble? Are we in that? Are we in a bubble in the stock market?
Yeah, it's a good question. You know, when I came back from holidays in January, all the talk was about bubbles and whether we're in one, because Jeremy Grantham had written a really salient piece on the market being in the mother of all bubbles, I think he described. Which is important because he's a wise investor. He's been investing for decades. He's seen this all before, and I have some sympathy for his view. But if I unpack his arguments, I find that they're not strong. There's a feeling that there's a bubble, but there's no real evidence that the entire market's in a bubble. So the first argument that he put up was that the S&P 500 is more expensive than it's ever been, with the exception of 1999, early 2000. And he was using Robert Shiller's CAPE ratio to point that out. And in fact, that ratio sits at about 36 or 37 times earnings. So what that is, it's a cyclically adjusted PE. So it takes inflation adjusted earnings over 10 years and compares the S&P 500 to that. And it's sitting about 36 or 37 times or thereabouts. If you go all the way back to 1870, it's only been higher than it is today once. And that was in 99, 2000, when we had, I was investing during that bubble and in the subsequent crash. And I remember it really, really well. Yeah. I actually worked for a big American bank, Merrill Lynch, and I remember in 1999, we were able to allocate stocks in new floats to our clients. That Merrill Lynch was a very, very powerful firm, winning lots of business, winning lots of IPOs. And in 1999, on the NASDAQ at least, the average first day premium was 90% wow. in 1999. So you made a lot of money wow. getting into IPOs and selling on the first day. But I lost clients because I sold them out on the opening trade. When a stock listed and it opened and started trading at about 11 o'clock, that was the time to sell, because these companies didn't make any money, and they were hoping to change the world, but it was way too early. You only had 150 million internet users in 1999. Today we have that many in Brazil, so it was really, really early. And my policy was, these companies don't make any money, just get out of them on the first day. Take your 90% average and you're done. And they left me and went to other advisors in the room because they held on. And then, of course, what happened around Easter time of 2000, it all collapsed and they all lost a lot of money. They would have been better off having sold out on the first day rather than hanging on. So I remember that really, really well. And there are elements of today that look like that. There's a lot of money flowing into IPOs. The IPOs all seem to be listing at significant premiums. It's what I call profitless prosperity. These are profitless companies, and the less profitable they are, the more they seem to go up. So there's a lot of that going on. Then you've got the whole cryptocurrency space, of course, which we talked about yesterday. And then you've got really interesting bubbles in individual stocks for individual stories. But that you can't infer from all of that the entire market is a bubble. And if you look at 25% of the S&P 500 is made up of 5 stocks. You've got Facebook, Amazon, Apple, Microsoft, and Alphabet or Google. They are demonstrating economics, the likes of which not only have we never seen, no business school ever even anticipated that businesses would be able to generate that kind of profit. You know, imagine a bank account where I said to you guys, I said, okay, you've got $1 million in your bank account, and for as long as you've got $1 million in there, I'll pay you 10% interest. But if you can get it to 20 million, I'll give you 20% interest. And if you can get to 50 million, I'll give you 30% interest. And if you can get $1 billion, I'll give you 50% interest. I mean, that's what capitalism is. I mean, that's the first prize asset, right? And so that's what these businesses are doing. Those 5 companies that I listed, as they grow their equity on their balance sheet, they generate a higher return on equity. Yeah. So imagine that. Imagine as you get bigger, you become even more profitable, not less profitable because the business is maturing. You become more profitable than before. So we've never anticipated businesses of such great quality. They're extraordinary businesses. Now, it's true that they might be a little bit expensive, but you know, I would argue that they are driving the index, and they are first prize assets. They are scarce assets. We've never seen them before in history, and they are, you know, they're really valuable to own. And so for that reason, I don't think that the PE is too high. It might be a bit high, but it's not overly high, particularly when you see where interest rates are today. And then all the bubbles that we just talked about a minute ago, well, let's look at last year. So last year, Hertz went bankrupt and its stock went up 1,100%, right? And then it collapsed 85%. Then we had Nikola. Nikola was this electric car or electric truck wannabe, right? Yeah. Then they got found out that they hadn't they just pushed a truck down? They just rolled a truck down the hill to keep it quiet, and then the share price collapsed, you know. And then there was Kodak as well. Kodak's shares. Kodak came out, said they were going to launch a cryptocurrency. Yeah. Right, Kodak Coin, I think it was going to be called.
I think it exists still.
Well, the stock went up 1,200% or something, then collapsed 95%. So you had bubbles forming and collapsing, but the rest of the market kept going. It didn't interrupt the rest of the market for the reason I mentioned earlier, and that is, as long as the assets aren't held on the balance sheets of systemically important financial institutions, you're not going to have a financial crisis. Yeah. So for those 2 reasons, I think there's elements of bubble, but I don't think the whole market's a bubble.
So we've just got to hope that the Federal Reserve doesn't buy GameStop and we'll be fine.
We'll be fine. Yeah. For now, I'm actually quite bullish over, notwithstanding that there could be a 10 or 15% correction at any time, and I believe that's a possibility for all the reasons we've just talked about. You know, the market just gets spooked. But I'm very bullish for this year, for the remainder of calendar 21 and for calendar 22.
So you've got those 5 companies you mentioned we've never seen before. When it comes to, like, you know, and you've mentioned the price a little bit overvalued, how do you think about value and growth when it comes to these, and I guess trying to put a value on potentially a business model that is traditionally very hard to value because we've never seen?
Yeah, well, the hardest stock to value is the stock that continuously exceeds expectations, right, for much longer than anticipated. So the traditional way of thinking about value, or the conventional way that, perhaps it's not conventional, but the way I think about value is we estimate what a sustainable rate of return on equity for a business is, and we apply that to the equity, and then we discount it, and we divide it up. There's a proportion that's paid out as a dividend. There's a proportion that we sort of discount a bit more, and then there's a proportion that is retained for growth. So a business that can generate very high rates of return on equity and also retain a large proportion of those profits and reinvest it back at equally high rates of return on equity, that's more valuable than a business that can't do that. A business that has a lower rate of return on equity, or a business that can't reinvest as large a proportion. So think the Australian Stock Exchange. It generates a high rate of return on equity, but it can't go opening up exchanges on every street corner. So its growth prospects are kind of limited. And so it's not going to increase in value as fast as, say, a Google or a Microsoft or an Apple, which can, only, I think it's 4.9 billion, or 49% of the world's population is connected to the internet. So there's still a very big portion of the globe that isn't connected yet. The runway's still very long for those businesses. So they can sustain high rates of return on equity for a very long time. That's one way of thinking about value. The other way of thinking about value is to say, well, look, in my 2-stage DCF, or discounted cash flow model that we all use, I've got an explicit period of 10 years where I believe the company is going to grow at 15%, and then I just whack in a terminal value based on the prospect of the company growing at GDP forever. You know, and it can't grow faster than GDP forever because then it becomes Earth, right? So it's got to be GDP or less than GDP. So you say that global GDP averages 2.5 or 3%. It's got to be less than that for your terminal value. And you come up with a valuation, use a discount rate that's appropriate, and you come up with a valuation. Here's the thing. If the company doesn't grow at 15% for 10 years, but it grows at 16% for 12, then you have way underestimated the value of that business. And value is lying in plain sight. And so businesses that can continue to exceed analysts' expectations, the companies that grow faster than expected, they're good value. So my question, back to your question, or my retort is that a value stock or is that a growth stock? It's both. You know, when the company lists on the exchange, the CEOs, the managers, the CEO, the CFO, the founders, they don't sit there going, we're a growth stock, we're a value stock. You know, they just say, we're a business that does this, and we believe we're going to grow at this rate. You can't value something unless you estimate its growth. And if you underestimate its growth, it's good value. You know, it's going to be cheap. And so I really think that the way the market is talking about the value growth conundrum or the value growth dichotomy, you know, it's wrong because they're saying that value stocks are low PE stocks and growth is something that's growing and the two shall never meet. Well, I actually think it's two sides of one coin.
We've been talking about that distinction a little bit, and it's I guess it's good we hear you say that because a lot of the experts we speak to on the podcast say similar things. You know, that they don't think of themselves as a value investor, they don't think of themselves as a growth investor. They learn from both. But that point around the terminal growth rate, I think, is quite an interesting one, and one I'd like to pick up on. You know, every DCF ever done about Apple or Microsoft in the last 20 years would be wrong. It would have undershot it.
So I wrote a blog post. I wrote a blog post back in 2009. If you go to rogermontgomery.com, you can look it up. And I think the stock was $13, and I said it was good value because I thought it was worth about 20.
Oh, wow.
Right? At the time. And it's exceeded, you know, it's continued to grow way beyond our, you know, explicit period of growth. It didn't grow just for, you know, 10 years and then slowed down to terminal growth rates or economic growth rates. It surged way past, and it's going to continue doing that. So it's worth much, much more than we first anticipated.
So then the question is, how do you think about a two-stage DCF with a lot of these businesses? You know, the Teslas, the Spotifys, these internet businesses that have similar unit economics to the Apples and the Microsoft that came before. Do we just have to throw the idea of a terminal growth rate out the window?
No, well, there are different ways. No, I think what you've got to do is all the work is done in understanding the competitive position of the company. That's really important. It's probably more important than the number that's thrown out of a DCF. You know, otherwise, if you focus purely on that DCF, then you rely too much on the valuation. It potentially prevents you from dreaming about, you know, can this business do much better than I'm anticipating? Is it possible that it grows for longer than I thought? Is it possible that it grows faster than I thought? Is it possible it grows faster for longer? You know, and so you tend to focus too much on that number. I have a back of the envelope way of valuing companies that when the PMs come back with their, you know, their expectations for a company based on their DCF, I will always just go and do my own little valuation on the back of the envelope. All I need is that, you know, I need a simple, I can use a primary school calculator and you know, a couple of stats, and I explained it in my book how to do it. And I come up with a valuation, and it's not a DCF. It's what we call an excess return model, or what's known in, you know, academia as an excess return model. And basically, what we're trying to understand is what's the sustainable rate of return on equity that is implied by the share price. And if that's lower than what we think it's going to achieve, then it's cheap, irrespective of what the share price has recently done. And that will help me have a conversation with the PMs about that particular stock.
we should say we've almost run out of time, but Roger's book is a classic. So if you want
a
to...
collector's item.
And a collector's item, yeah.
You need to get some more supply out there.
Yeah.
I should say the unsigned version is a collector's item.
Okay.
Because
Yeah,
they're
have
all
you signed a
signed.
lot of
I've
them?
signed a lot of them.
I felt special because I had a signed
Yeah,
version.
no,
but-
my wife has the rare unsigned copy.
Okay. But yeah, if you want to learn more about some of the valuation stuff that we've spoken about today, highly recommend the book Valuable.
Yep.
Is that how you pronounce it, or is it
It is.
valuable?
No, it's Valuable.
Yeah, okay,
Valuable.
Yeah. I've always wondered that,
Yeah.
so I'm glad we got you on to ask
I was
that.
really proud that the Reserve Bank of Australia gave us permission to use the dollar coin as the dot between value and able.
Get approved
I
for
would
that.
you have
never
to get
have thought you had
approval
to get
for that.
approval. Yeah, right. There,
Well,
you go. Things you learn.
Learning new things on Equity Mates all the time. Well, that is all we have time for today. So Roger, thank you again.
Pleasure.
We'll be back tomorrow for 3 stocks on Roger's watch list or in his portfolio and do a bit of deep dive on them. But until then, we'll see you tomorrow.
Equity Mates, from our mates at Spaceship. Investing made easy.